Hey everyone, it's John Hopkins with the Broker Mortgage Team, bringing you your weekly housing market update. Here's a look at what moved the market last week, why it happened, and what's on deck for this week. So let's start. What happened this week? Well, let's start with mortgage rates. Conventional 30-year fixed finished the week at 6.67%, which was definitely a decrease. VA 30-year fixed at 6.15%. FHA 30-year fixed at 6.34%. And if you're looking to buy something north of 800,000, jumbo at 7.32. What were the market drivers? Well, the Fed held rates steady at 4.5%, reaffirming that future rate cuts depend on continued inflation progress. Tariff news shook the markets, with investors reacting negatively to a proposed 25% tariff on Mexico and Canada. This caused stock prices to dip and bond yields to rise, pushing mortgage rates slightly higher. We also had some economic data misses. Q4 gross domestic product came in at 2.3%, lower than the expected 2.6%, which signals a slowing economy. Pending home sales dropped by 5.5%, a significant miss compared to the expected flat growth. Jobless claims, they came in lower than forecast, 207,000 versus 220, showing continued labor market resilience. As we look at the housing market, new home sales rose 4.09% in December, showing continued demand despite high mortgage rates. Builder confidence improved up 4.88% as builders anticipate more buyers entering the market this spring. So why did all this happen? Well, it was inflation and the Fed. The core PCE, the Fed's preferred inflation index, held at 2.8% year over year, but still above the Fed's 2% target. This means rate cuts are not happening soon unless inflation slows further. Tariffs created market volatility. The proposed tariffs have created economic uncertainty, leading investors to sell stocks and push bond yields up, influencing mortgage rates. Seasonal shifts, spring inventory is starting to increase, but affordability remains a challenge as rates remain elevated. So what's on deck for the week ahead? Well, the key reports to watch are the ISM Manufacturing PMI. Today will show economic health and inflation trends. The JOLTS job openings on Tuesday could signal labor market softening or continued strength. This Wednesday, ADP jobs report, a preview of Friday's big jobs report, non-farm payrolls, and unemployment rate on Friday. This will be huge for rates. A weaker than expected report could help lower rates, while strong jobs could keep rates elevated. So what's the watch? Well, the 10-year Treasury yield is at 4.54. Any movement here is going to impact mortgage rates. As we look at the spring market trends, more sellers are expected to list their homes in the next 30 to 60 days, giving buyers more options. Demands remain solid, but affordability will be key in how fast homes move. What does this mean for you? Buyers, lock in a rate if you find the right home. Inventory is rising slightly, but prices remain high. Waiting could mean facing more competition in the spring market. Sellers, you still have an advantage, but as more homes hit the market, pricing competitively will be key to attracting buyers quickly. That's your Market Pulse update. Stay informed, stay strategic, and let me know if you have questions. See you next week. Bye.